Hello, everyone, and welcome. My name is Mahmoud Alkudsi, and I'm Senior Market Strategist in ADSS. Well, today we're going to talk about reversal patterns in technical analysis. How could we spot them on the chart? And how could we employ them in our trading process? So without any further ado, let's get started with the risk disclaimer. So in terms of the risk disclaimer, the content of this presentation is purely educational and doesn't constitute at all any trading advice. So the first question that comes to my mind when I want to trade the market, how can I define my entry and exit points? So let's think about it. I don't want to trade haphazardly. I don't want to choose my entry and exit point at random. I want to be organized, and I want to find out the way that I can potentially make profit. So the answer of this question is by applying technical analysis principles. So what is technical analysis? Technical analysis studies the market in terms of the price action, i.e., it says that the history repeats itself, i.e., some of the traders, or let's just say the biggest majority of traders, they tend to behave in a specific way sometimes and all the times, sometimes in specific situations, risk on, risk off, etc. So these signals that we get from the market are telling us who is the dominating part in the market, bulls or bears. And by knowing who is the dominating part, I have to join this part. In that case, if I just monitor these parts and I follow them, I can make a very successful trade. So reversal patterns, they used to show in any market, whether it was FX, commodities, etc. And at the same time, there are two categories. We have the reversal and we have the continuation. So what is the reversal? The reversal is telling me we have a trend, and when I see this shape or this pattern in the market, is telling me that there's a big possibility that the market will reverse. So if I have an uptrend, this uptrend, it might reverse to become a downtrend and vice versa. Makes sense, right? On the other hand, the continuation pattern is kind of a timeout from the market. It's saying to me, let's take a pause until see what's going on in the market. So if I have an uptrend and I see this shape, the most probable that the uptrend is going to continue. But there is very important detail about these patterns. I have to have a clear, and I have to underline the word clear, pattern before the clear trend before this pattern. So I have to have an uptrend, or I have a downtrend, because a sideways trend before these patterns doesn't serve me. I can't apply these patterns if I have a sideways trend. All right? So what are these trends? The trends, we have the uptrend, which is a series of highs with higher highs and lows with higher lows, i.e., the bulls were in charge to push the price upward. And we have also the downtrend. The downtrend is a series of highs with lows, lower highs and lower lows. So in that case, the bears were in charge and were successful to push the price lower. But we have the sideways move, i.e. a trendless move. We have a series of lower highs with higher lows. In that case, the market is moving horizontally and there is no part in charge, nor the bears or the bulls. So, as this introduction, we can see who are our guests today, if you will. Head and shoulders, inverse head and shoulders, the double top, the double bottom, the triple top, and the triple bottom. And I will try to make it as simpler as I can, because believe me guys, it's very simple and it's very straightforward and is very helpful in the trading process. So let's get started with the head and shoulders. So first of all, I need to look at the chart. I have to have an uptrend, because This pattern is a bearish pattern. So if I have an uptrend, I have to try to spot the left shoulder, the head, and the right shoulder. And then I have to draw the neckline. What is the importance of the neckline? The neckline helps me a lot in defining my exit and my entry points. We remember at the start of this presentation, how can I define my entry and exit points? So through these patterns, I can measure distance from the head to the neckline and apply the same distance to the downside, so I can short the market below the neckline. Again, my exit point is at the target of this pattern. And where is my entry point? Is below the neckline. So as I said, my potential entry points are below the neckline, so I'm good to short the market below the neckline, and my exit point is at the target of the pattern. So let's take an example on the chart. So here we see the uptrend, as we see highs with higher highs and lows with higher lows. All right, so this is the first condition I would tick it. Then I spot the left shoulder, the head, and the right shoulder, and then I can draw the neckline. So where is my entry and exit point in this trade? I have to measure distance from the head to the neckline, apply the same distance to the downside, and my entry points are obviously below the neckline. All right, so as I said, and sometimes the market might give me more than one opportunity to trade or to process this trade. The first one is right away after the break below the neckline, and the second one, as we see here, the market rallied, tested the neckline again, and then failed, and then continued to trade lower. So we need to be very careful and kind of as snipers in order just to spot these opportunities and trade them. So, and as we see here, we had an uptrend, and what was an uptrend became a downtrend. Why? Because this is a bearish reversal pattern. So let's move to the following pattern, which is an inverse head and shoulders. The inverse head and shoulders is a bullish pattern. So what is the distinguish between the bearish and bullish? A bullish is going to the upside, and bearish is going to the upside, to the downside. So I have to see where the start is from. The start here is a downside. In our previous example, the start was an uptrend. So here we have a downtrend. We spot the left shoulder, we spot the head, and we spot the right shoulder. And then we have drawn the neckline. Then we measure distance from the head to the neckline and apply the distance to the upside. And here I have my possible entry points. So it's very simple, very straightforward. I have to see the trend, the downtrend, spot the shape or the formation of the head and shoulders, whether it was an inverted or a normal, and then be careful and draw the neckline properly, and then I can go long, i.e. I can buy above the neckline if the pattern is bullish, and I can short the market if the pattern is bearish. So here my possible entry points are above the neckline, and also my exit point is at the target of this pattern. And let's see an example on the chart. Here we see a downtrend, which is a series of lows with higher lows and highs with lower highs. Okay, first condition ticked. Then I can see the left shoulder, the head, and the right shoulder. So the formation is also ticked. I draw the neckline and then measure a distance from the head to the neckline and apply it to the upside, so I can find my target or my exit point, and obviously I can buy above the neckline. So it is very important to wait until the break happens. I have to buy either above the neckline or below the neckline. If we have a bullish pattern, I have to buy above the neckline, and if it's a bearish pattern, I have to short below the neckline. And as we see here, the market reversed because it is a reversal pattern anyway. Our following pattern is a double top. The double top also is a bearish pattern. We have an uptrend, we have the first top, and then the second top. And what we say, it's the exact same. You know the drill. We draw the neckline, and then we measure distance from the first stop to the neckline and apply it from the breaking point. So if I apply it from the breaking point, I've got my exit point, and obviously my entry points are always below the neckline. Okay? So it's very straightforward, and it makes sense all the way. So here, as we see here, we have a high with higher highs and lows with higher lows. So we have the uptrend, we spot the first stop, we spot the second top, and then we drew the neckline. So the rest is yours. As we see here, we can short the market after the break below the neckline as we measure a distance from the first stop to the neckline, apply it to the downside. We have our exit points and our entry point always in the bearish pattern below the neckline. And as we see, the market rewarded me another opportunity to trade this pattern, as after it hit its target, it went to retest the neckline, tested it, and then failed to break above it and to continue above it. Then I had another trading opportunity, and the trend, which was uptrend, it became a downtrend. Very simple, very easy. The double bottom pattern, it's a bullish pattern. We have a downtrend, we spot the first bottom, we spot the second bottom, and then we draw the neckline. And as you see, my entry point is going to be above the neckline, my possible entry point, and my exit point is at the target of this pattern. All right? So it's like, you know, whenever you check the chart and you see something as simple and as clear as that, okay? But bear with me, guys, because these patterns, as long as they are very simple and straightforward, but they are infallible, no, I wouldn't say they are infallible. Always I have to have in mind that the chart or the market might reverse on me. So I have always to trade with a risk management strategy. However, this is a plan. Yes, it is a plan. If I accumulate more signal with it, it is a very good plan. And also, I don't have to omit the risk management strategy that I'm using. So let's go to the example here with us on the chart, on the gold chart. Here we go. We have a downtrend, and then we spot the first bottom. We spot the second bottom. We drew the neckline. Okay? We measure the distance from the first bottom to the neckline and apply it to the upside. Our entry point here in this bullish pattern is above the neckline, and my exit point is obviously at the target of this pattern. Okay? So, following, and as we see here, the market has reversed because we insist it is a reversal pattern. A triple top pattern, you know the drill. We have an uptrend, we spot the first top, the second top, a third top, and then we draw the neckline. We measure distance from the second top to the neckline, apply it to the downside, and my possible entry points are below the neckline, and my exit point is obviously, as you see, by the target of this pattern. And let's take another example on the silver this time. We see here an uptrend, then we spot the first top, second top, third top, and then we draw the neckline, measure distance from the second top to the neckline, apply it to the downside, and then here we go. We've got a very successful trade. Okay, so my entry point below the neckline, and then my exit point is at the target of this pattern. And last but not least, the last pattern with me today is the triple bottom pattern. We have a downtrend. I spot the first bottom, the second bottom, the third bottom, and then drawing the neckline, measure distance from the second bottom to the neckline, apply it to the upside. So I've got my entry point above the neckline. I'm good to go to buy above the neckline. And my target or my exit point is where we see after the measuring the distance. And then let's take an example on that. On the Kiwi Japanese yen, we have a downtrend. We see the first bottom, second bottom, the third bottom. We draw the neckline, measure distance, apply to the upside, and as you see here, what was a downside trend became an uptrend.